Vinod Karki joining us now. He's Senior VP Equity Research at ICICI Securities on our segment Talking Point, where we look at the big picture with our special guest. Vinod, great to have you on the show, and thank you so much for joining in today. I want to start by asking you whether it's time for a reset in terms of an overall approach, and this is for a lot of our viewers who may be watching right now, in terms of an approach of how you are looking at stock picking, how you're looking at, the indices and their movement.
Hi, good morning. And I think, nothing has changed fundamentally. This is kind of a repeat of what we saw in 2022, if you remember, when the first jumbo rate hike started happening and the bond yields in the US rose like significantly. If you remember, during that time, that was one of the major corrections in this bull market where the Nifty fell close to, I think, 15% from the top. The current thing is also all fundamentally driven by the same factor, I guess, more or less. The bond yields in the US have risen 130 bips from September, and where we formed the peak of the market valuations at around 23 times. And we are currently just around 20x, I guess. A similar playbook was there in 2022. We had reached north of 23 times. And because of those jumbo rate hikes and the global uncertainty, equity valuations moderated, which is a fundamental angle. So, but this time around, the difference is the bond yields, which rose in 2022, were a big, normalization from ultra low interest rates in the US, which was near zero after the COVID impact, to those four-ish number. Here, it is more to do with some kind of the new administration of Trump really, which their policy seems to be inflationary. So it's more speculative at this point in time rather than because if you look at the Fed speak, it is very clear that they are very confident that significant progress has been made on the inflation front, and it is headed towards their objective of 2% over the period of time. But this Trump effect, which seems to be, kind of igniting this expectation that there will be a sharp increase in inflation due to the Trump policies, that's driving this very, very different environment where since August, September, the Fed has been cutting rates, but the bond yield spiked 130 bips. So I think this is some kind of a speculative thing which is happening. I think as Trump takes his position as the president and starts announcing, people will realize that it was a little premature to kind of.
You think so? You think so, Mr. Karki, that people will realize it was premature? Or will it be an underestimation? Because we don't know for sure.
No. So if you look at the history, same thing happened. Exactly the same playbook. It was like this in CY16, November, when Trump came to power initially. There was this huge euphoria around Trump policies and the tariff policies and things like that. And there was a similar big spike in the dollar index, bond yields rose. It was exactly the same thing. Once January came and he starts actually to announce the policies which people thought were underwhelming, in the sense, and even if they were at par, the market has already acted on that, basically, So the classic buy on rumors, sell on news kind of thing. I think that's what's going to play out. As the actual events happen, the market has already positioned itself for the worst outcome. So that's how I feel that this significant spike in bond yields in the US is unwarranted, I guess. We are almost at 5%, while the inflation trajectory is, there is no signal to suggest that it's moving to the contrary significantly. There have been some misses on the inflation path, but it's still trending towards that 2 to 3% range. So yeah.
Interesting. So, Vinod, good morning, Neeraj here. How do you then position? I mean, for this, would you go out on a limb and try and take a position, waiting for the reversal, which is essentially buy the rumor, sell the news, or sell the rumor, buy the new event as it actually happens, or would it be because the timing of this might be uncertain as to what's the extent of bargain that Trump uses for various things? When does inflation not go up as much as people right now fear, etc.? So would you wait for things to materialize and then put money to work? Or would you preempt some
No,
of these things and put money to work right now?
yeah. So the way, I mean, behaviorally, if you see when the uncertainty is the highest and not kind of born out of clear fundamentals, but some amount of speculation, that's when I think the comfort is higher. So while it's still a probability game, you never know these things, and you can never call out exactly how it's going to happen. But the thing is that now is the right time because the earnings yield is north of 5% now on the Nifty, which is quite comforting, I would say, that way. But as you rightly said, some shock announcements and other things can be ruled out. But point is, now you are at reasonable valuation. So to answer a question, one should start allocating, not go the full, allocate completely because you don't know how things will actually pan out. But given how the market is right now in terms of higher uncertainty born out of speculative factors, I guess this is time to start buying.
Okay. Vinod, just wondering, because there's just so much of skepticism around what will happen. It's almost that for the first time in the last 4 years, the retail is seeing a meaningful correction which is not being bought at the first major dip, right? Because this is the dip that is not quite seeing the buying that people have been used to. Sure, there was an intermediate 4-month, 5-month period correction as well that happened, but it probably wasn't as severe. My question is, because earnings are slowing, because there is a Trump 2.0 era and a few uncertainties out there, could it well happen that this finally is the one dip that doesn't get bought in a V shape because of various extraneous factors and fundamental factors around it?
Yeah, so Neeraj, clearly what we have been advocating is that relatively the large caps, and I've been saying that quite some time, that large caps offer much better risk reward at this point in time. And they have been for the last year or so. While there was euphoria on the broader market, small cap, micro caps, and all, uh, um, it the large caps, I mean the Nifty, was relatively much better off in terms of the euphoria or the expectations. So I think what I'm talking about is the headline index. Broader markets are still a little worrisome area because they have had significant run over the last year or so, and they have outperformed quite a bit. So I think these things will mean revert. Some of the high outperformance of the smaller mid cap companies might come off. But if you were to talk about the headline Nifty index, it looks reasonably well placed.
Okay. Vinod, one quick 30 or 50-second answer because we're completely out of time. But what's the portfolio strategy, Vinod? What sectors are the top draw currently with the view that you have currently?
So I think with the what you should say the election fervor gone, and next year there will be more focus on the development side of the economy. I believe that the cyclicals, which are industrials and large financial companies, and even commodities and commodity prices. I mean, one effect of this Trump has been that commodity prices have started to inch up. So realization of commodity companies. And all these spaces have reasonably good valuations, be it large financials, some industrials at least, large cap industrials, and some of the financial companies, telecom. I mean, these sectors broadly look good to us, both from valuation perspective and our view that from RevX, the focus is going to shift to capex in the forthcoming budget, and fiscal prudence will be of prime importance given the external risks the economy faces right now. So, yeah.
Okay. Well, Vinod, thank you for joining in today and giving us your thoughts on this show. And looking forward to, of course, talking to you soon on an extended conversation.